A minuscule portion of the taxes you'll save will pay for tons of life insurance coverage. In this educational episode, I'm going to address how do you self-insure with IUL. This is one of the most common misunderstood concepts with life insurance. Get ready. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades, helping people optimize their assets, minimize taxes, prepare for a comfortable retirement so they will not outlive their money. And one of my favorite financial vehicles, bar none, to help people achieve their goals of having their money be liquid, safe, earning a predictable rate of return, and also being totally immune from the negative impact of taxes, inflation, and market volatility. Those 3 negatives, those 3 dangers are what cause most retirees to outlive their money. So I make people immune from those. What vehicle does that? It's a max-funded, indexed universal life insurance contract, structured correctly and funded properly. If it is deemed what I call a laser, L-A-S-E-R, fund. Laser is an acronym that stands for Liquid Asset Safely Earning Returns, okay? And so at the end of this episode, I'm going to gift you a copy of my most recent best-selling book called The Laser Fund so that you can understand this, because there's so many misconceptions out there. And whenever I hear people criticize or say, well, how do you self-insure? They don't know what they don't know. So here we go. I want to use this insurance contract for living benefits. It is the brainchild of E.F. Hutton back in 1980. And they designed universal life to be used primarily for living benefits, not the death benefit, for tax-free accumulation and tax-free income that would knock the socks off of, accounts like IRAs and 401ks. Now, what E.F. Hutton realized back in the 1970s and 80s is that in the Internal Revenue Code for decades, and now it's been 108 years, there's really only one vehicle in the Internal Revenue Code that allows you to accumulate money tax-free under Section 72E of the code, and then allows you to access that money, all the growth and gain when you do it the smart way tax-free. And that's under Section 7702 of the Internal Revenue Code. And then at the end of the day, when you pass away, whether it's at age 40, 60, 80, 120, anything left in the account transfers tax-free, and it usually blossoms. It increases in value and transfers tax-free under Section 101A. Okay? Now, this is insurance, life insurance. I'm talking about permanent insurance. But up until 1980, there was only whole life and that accumulated money tax-free. And they were okay, but they were primarily designed on a chassis for death benefit to guarantee that the money would transfer in a tax-free death benefit when you ultimately died. And so you had to pay a certain amount of money into it to have those guarantees. But it was primarily to guarantee the death benefit. And so E.F. Hutton just said, we can get rid of the need for those guarantees in short order by maximum funding it and having people self-insure within 5 years or less. So this was the emergence of universal life. And to this day, there are a lot of agents that don't understand this. And you hear, the Dave Ramsey say, oh, the problem with life insurance is it's got this ART, an annual renewable term component in it. And the cost of insurance goes up higher and higher the older you get. Yeah, the cost per thousand goes up. Yeah. And then he stops because, bless his heart, he doesn't get it. The cost per thousand goes up, but the amount of thousands that the insurance company is charging you is going down dramatically. And so you ultimately are self-insured. There is no cost of the insurance because your cash value equals and exceeds the death benefit, usually within 12 years. This is called self-insuring. So please watch how this works. Under these sections of the code, the money accumulates tax-free. You can access it tax-free. When you die, it blossoms and transfers tax-free. Now, because this was introduced in 1980, there was a massive exodus of money that began to leave the banks, the brokerage firms, and so forth into these. And I had clients put in $500,000 in 1980, 81, 82 in one fell swoop. And they could put in 500,000, and they actually could do that clear up until June 21st of 1988. And back then it was a high interest environment, and the general account portfolios of the insurance companies were earning on their AAA and AA bonds and mortgages on shopping malls and skyscrapers between 11 to 15 or 16%. Interest rates were high. My mortgage on my house at that time was 12%. The second mortgage was 18%. CDs that banks were paying 10. Interest rates are relative. So when I started putting money into Universal Life, and I had clients doing this, they would put in 500,000, and they earned between 11 and 3/4 and 15.5% through the 1980s to the early 1990s. Okay, and then Indexed Universal Life came out in 1997 when interest rates started coming down, so that people could still earn 11, 10. But let's just round down to 11, because that's what I've averaged now ever since 1980 is 11.17. By rebalancing and diversifying, and also by making sure that we rebalance every single year. Now, a lot of times advisors think they know what I'm talking about, and they don't. And they tout diversification in their mutual funds. They tout rebalancing a portfolio. But then they close off their mind when I start talking about the same thing with Indexed Universal Life, and they don't get it. It's like, you don't even get it then for your own investments that you're proposing. So what happened is this money was leaving into the insurance policies, and the IRS came and said, we think you're violating or overstepping or trespassing these sections of the code, because who puts $500,000 into a dinky little life insurance policy, maybe $100,000 policy? Did you understand what I just said? People were putting $500,000 into a $100,000 death benefit policy. And the IRS said, who does that? And the Hutton said, our clients do. Well, then in 1982 and 1984, under the Tax Equity Fiscal Responsibility Act and the Deficit Reduction Act, the IRS convinced Congress to pass these tax citations that said, come on. In order to not violate the definition of tax-free life insurance, you've got to have a commensurate amount of insurance coming along for the ride attached to the account, so that this doesn't move over to the taxable section of the Internal Revenue Code, investments. You've got to stay under the insurance-protected, tax-free portion of the code, these sections. And so TEFRA and DEFRA basically said that you had to have a minimum amount of insurance attached, but you could take the least amount under TEFRA and DEFRA that the IRS would let you get away with, and now your money turns into this tax-free cash cow, and the cash can equal and exceed the death benefit if you want it to. So stay with me and I'll show you how. And then, because there was a massive exodus of money leaving the banks and brokerage firms into these because they were safer, they paid higher interest, they were tax-free, they blossomed when they died, they couldn't compete. So June 21st, 1988, under the Technical Miscellaneous Revenue Act, they said, we want to slow the flow. We don't want to kill these. Why? Well, because this is where banks and credit unions put 30 to 40% of their Tier 1 assets for liquidity and safety. They borrow money from the public, OPM, and pay 1 or 2%. They turn around and make 4 to 8% in insurance companies that are safer. 6 notches higher in safety, generally, okay, over banks. They reposition the money you're putting in the bank to make it more safe by putting it into insurance companies in BOLI, bank-owned life insurance, and they turn around and make 4 or 5 times what they pay you. That's called a 400 or 500% return. This is how money works. You can bypass the middleman. So TAMRA slowed the flow. These have to do with the minimum amount of insurance. This has to do with how fast you can fund it so that when you access money under 7702, it stays tax-free. If you violate TAMRA, it only accumulates tax-deferred, like an IRA or 401k. But when you go to access it, it now becomes taxable. Most people want to generate tax-free income. So how do you self-insure? I've often compared this metaphorically to a bucket. Let's say the IUL is a repository, a bucket that's going to hold money. You are designing the bucket to accommodate the amount of contributions you want to be grandfathered to put into it. You're not obligated to put that much in, but you cannot put in $1 more or the insurance company must refund it. So let's say you're a 60-year-old male and you want to be grandfathered to be able to put $500,000 into this bucket. You could take 30 years to do it. You could start out with a big lump sum and then coast for 10 years. It's so flexible. That's why it's called universal life. But let's say you want to get the money in as quick as possible. And so the minimum amount of insurance, because you could buy a ton of life insurance for $500,000. That's not the objective. Teffer and Differ says if you're 60, you can get away with $1 million of life insurance. Now, agents who do not understand this, they say, well, you should always choose the increasing death benefit. Level is the devil. What? You only choose the increasing death benefit with indexed universal life if you are socking away, $100, $200, $500 a month starting at age 30 until you finally stop putting money in the bucket, you've reached your limit, and then you switch over to the level death benefit. What does the increasing death benefit mean? It means if I put in $500,000 and I die, the insurance company is going to pay out my $1 million plus $500,000. Well, they're going to keep charging you for the original $1 million if you do that. If you're using it for living benefits, you say, no, I want the level death benefit. If you're going to be putting in enough money in the first 5 or 10 years and you're older, you choose the level death benefit to self-insure. Why? When I want to reposition $500,000, Tamara says, I can only do it about, 20 to 25% a year, 100 to 125 grand. We'll just say 100 grand. You can put in 100 grand the first day of the first year, the first day of the second year, another 100 grand, the first day of the third, first day of the fourth, first day of the fifth year is technically 4 years and 1 day into the IUL contract. So far, so good. Now, every time I add money to it, the cash that I'm putting in and the interest I'm earning on that cash is part of the death benefit under the level death benefit. People say, why would you do that? Because I'm not interested in increasing that. I'm interested in increasing that. And so in order to do that, you want to have the spigot on the bucket, which is the cost of the insurance, get smaller as you get older. This is what Dave Ramsey doesn't understand. You are letting the insurance, even though the cost of insurance per thousand goes up, the amount of thousands you are being charged for is half in 4 years and 1 day. Why? Because if I have 500 grand in there, the original death benefit was $1 million and I die, they're only paying out $1 million. So the net amount at risk is only 500,000. They are only charging me after 4 years and 1 day, the actual cost of the insurance for 500,000 of net amount at risk, not the full $1 million anymore. With the increasing death benefit, they're charging you for the whole $1 million. The spigot on the bucket remains large. So what's the effect of that? I want to earn, let's say 11 and net 10 as soon as possible. If you earned 11 and you kept the increasing death benefit, you're going to be lucky to net 6 or 7 because that spigot on the bucket's going to remain huge. As you get older, the cost on $1 million of insurance is just going to keep getting bigger and bigger and bigger. Now, hopefully the cash is earning enough that it's offsetting that, but you're earning 11 and netting 6, 7, or 8. I'd rather earn 11 and net 10. How do I do that? I self-insure. So after I get this in 4 years and 1 day, I've averaged 9.62% on mine since 1980. A combination of universal life and then later indexed universal life. If you understand the rule of 72, you divide 9.6 into 72. My money will double every 7.5 years. So 7.5 years from 4 years and 1 day, when I've got my total I'm allowed to put in there, this is doubled. So in the 12th year, now this 500,000 has doubled to $1 million. So my cash is equal to the death benefit. Yep. What's the insurance company at risk for? Zip. I'm self-insured. This is like buy term invest the difference on steroids. The end goal of buy term invest the difference is to have enough money that you can get rid of your term insurance 30 or 40 years down the road. I did it here in 12 years. So my cash equals the death benefit. Teffer and Deffer simply says, if you happen to die that year, the insurance company will pay out $1,050,000 because the death benefit has to stay 5% ahead of your cash. But if you don't die and the 500,000 doubles to $1 million, in another 7.5 years, that $1 million doubles to $2 million. If you die that year, the insurance company pays out $2.1 million. They're only charging you for that 50 or that 100,000. The cost of insurance on 100,000 versus the interest you're earning on $2 million is minuscule. If you were to look at the later years of my IUL policies, if I earn 11 in a given year now, I'm netting 10.9 because the cost of insurance is only costing 0.1%. But retroactive back to day one, it's been an average of about 1. I earn 11, I net 10 because I self-insure. Hopefully, this has given you some insights into opportunities that you didn't know existed before. If you want to learn more, I would recommend you study this book called The Laser Fund. It's my 11th book. It's been flying off of our warehouse shelves. And if you go to Amazon, they're $20 plus shipping and handling. If you do that, thank you, but I'll gift you one free. So you can claim a free copy by going to laserfund.com, laserfund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. I require some skin in the game, and I'll pay for the book. I'll fire out a hard copy to you via priority mail. But while you're claiming your free copy, if you'd like to listen and learn or watch and learn, there's audio and video formats. You can also register for a free educational webinar, which we do on a regular basis. You can even schedule an appointment to talk to a specialist who understands how to structure these correctly, like I just talked about, so that you can self-insure as quickly as possible and have your insurance get cheaper as you get older. Have you ever seen an insurance policy that gets cheaper as you get older? Well, I guess Dave Ramsey hasn't either. But that doesn't mean they don't exist, okay? Sometimes people say, well, I've never seen one of those. Oh, really? So that's your reasoning. Have you ever seen your brain? Well, how do you know that even exists if you've never seen that? Because they think, because they've never seen it, it must not exist. That's fallacious thinking. So make sure you claim your free copy. It's actually 2 books in one. This side is the left brain side with all the charts and graphs. This side is the right brain side with all the stories. And if you want to use your whole brain, read both books. But this is not about me. This is about you. And I don't want you to miss out on opportunities to where you can sort of have a minuscule portion of the interest you're earning on your life insurance actually pay for your life insurance. Nothing's free, but I don't pay for my life insurance. It's being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary income tax that most Americans shell out if they put money in IRAs and 401ks. So I'll take as much insurance as I can get if I don't have to pay for it. I let Uncle Sam pay for it indirectly. Does that make sense?